In spite of all the drama in D.C., the markets are staging a big comeback thanks to some cooler-than-expected inflation data. Michael Farr is president and CEO of Farr Miller in Washington. He's also chief market strategist at Hightower Advisors and a CNBC contributor. Ron Insana, CNBC senior analyst and commentator, as well as CEO of I feel like Dr. Seuss. Yeah. I. All right, so let's go back.
I wish I had a Seussian rejoinder.
Let's go to the previous story. Do the markets really care whether the government has a shutdown? We've been through this 15 times
since 1995. Yeah. We've done this. I think to the extent that it creates a chaotic environment and raises questions about what the incoming administration is going to do from a policy perspective, it may care. But as Kelly was saying at the top of the show, you have the inflation data, the Fed's preferred gauge coming in softer than expected. And that was part and parcel of why the markets fell apart just the other day was,
worries that inflation was going to come in higher than expected.
Yeah, and the Fed was going to cut less in 2025. I still think the Fed's going to cut less in 2025. I've kind of changed my view on that. And I think this is a much rockier road ahead for Wall Street after, nearly 60% in total return over 2 years. We're one overdue for a 10% correction, if not overdue for something else.
I feel like I'm going back in the other camp. After the PCE this morning, that's it. No more inflation. Just going to be up 1/10 and ho hum. Nothing to see here. And cut a few more times and maybe everything is fine.
Although growth is accelerating, not decelerating. The Atlanta Fed has fourth quarter growth of 3.2%. Third quarter was revised upward. We don't know that we're slowing down. And there's still some sticky spots, sadly, on the inflation front. Some of it doesn't make any sense at all. Some of it, paying your financial advisor more because assets are up and so they're drawing greater fees. That's not inflation.
Michael, you say we're returning to the old normal. That sounds like a bourbon brand to me. What is it? What does that mean?
Well, I think you might need a new bourbon brand if we continue.
I remember some bad nights on a potion called Old Crow. Really bad nights.
Oh, that's rock gut, but it was cheap, and in college, who
it was
cared?
Cheap. Yeah,
$1.99, as I recall.
When Wall Street gets surprised, that's the old normal, and it's not a good thing. And this week, Wall Street got surprised, of course, by the milder Fed message and by, I suppose, a consistently dysfunctional message from Congress. We thought that they had the ball across the goal line and no dice. So Wall Street today is telling you that what we really care about is what the Fed does. And we're still going to turn a deaf ear to Washington until they get back in our faces in a bigger way. But the volatility created from the messaging, both from Washington and I think markets and the Fed had markets reeling this week. As Ron said, we're in an expansionary phase, generally that shouldn't be derailed. But you've got to watch this data, and the Fed has been data dependent, and markets hate it when they're data dependent unless they happen to like the data the Fed's looking at.
I'm still thinking about Old Crow, which is just such a great name. So, Michael, tactically, where does this leave you then, right? Are you repositioning? Even on the good old question of kind of stocks versus bonds, and what should they comprise of your portfolio?
We've got still a really heavily weighted S&P 500 that's just in 5-7 names. We all know what they are. Really concentrated. The market's still trading near all-time high multiples. So I think it's really a stock picker's market, real stock picker's market. I was talking to the producers this morning. I like things when they've pulled back. So I said, well, Adobe's gotten killed. I think that's silly. I don't know why Adobe's gotten killed. Great gross margins, great free cash flow, great cash on the balance sheet. And I looked at a smaller one that's pulled back 15% was Valmont, which is one I've liked a long time. I own both the stocks, but I like to buy stuff when it's out of favor and when it's getting pounded down, I think, unreasonably. That's what I think you have to do, Kelly, going forward. Stock by stock. I think this next year is going to be a real stock picker's market.
You remember, Ron, when you and I were young pups?
No, I don't, actually.
Well, actually, I don't really either. I actually don't either. But in the late 90s, as Kelly's pointed out, there were several years where we had back-to-back years of 20%.
I think.
Yeah.
20% gains.
In 1999, NASDAQ was up 85%.
Yeah.
So, I mean,
You do not see that in the cards for next year.
Look, I think for the rest of this year, the market will do what the market will do. I think 2025 is going to be far more challenging than anybody currently assumes, given the policy uncertainties. When you take the individual policies that the Trump administration is proposing, the incoming Trump administration, at face value, assuming they can do what they say they're going to do. When you look at tariffs, mass deportations, you look at potential for tax cuts, which increase the size of the deficit, and then you look at deregulation, which could be positive for some industries, obviously. I think the net is still stagflationary, and I think that puts the Fed in a box. And so we could disaggregate that however you like, but I mean, when I just look at everything, taken in sum, I don't think it's.
Do you think there'll be conflict between the administration and the Fed?
Ultimately, yeah. I mean, if the Fed's going to cut twice, you're going to hear from incoming President Donald Trump that he was favoring Joe Biden on the way out and maybe disadvantaging him on the way in. He can't do anything about it necessarily. I mean, unless Jay Powell were to leave voluntarily before his term would expire, but he's indicated he has no intention of doing that. So, yeah, you could see President Trump and incoming Treasury Secretary Scott Bessent, at war, if you will, over policy. But again, I think, the policies as we understand them from Trump 2.0, net are stagflationary.
You think they're stagflation? I wonder if they're a little bit more, almost more. The economy, let's put it this way, it's a good thing the economy is so strong, right? Because at the margin, it sounds like it's going to clip the sales a little bit, because certainly anything that would be pro-growth, which is, changing the federal government stuff, the tax, I mean, that's going to be a ways down the road. It's the opposite of the first administration, where they did tax first and then a lot of other things later. This time, I mean, maybe by the end of next year, but it's not going to be the first thing to hit the markets.
No, and they're still saying day one, they're going to impose tariffs on many of our trading partners. Day one, they're going to start a mass deportation process. That is both inflationary and recessionary simultaneously. So that would be the first thing, presumably, that hits, if it all is not challenged.
Michael, why don't you tie it off here and react to what Ron's sort of view of a bumpy year at the very least?
I think a bumpy year, from a lot of it's caused by the messaging. I think I'd issue a bit of a warning to Elon Musk, though I'm not sure he'll listen, but I'm sure he's watching. So, Mr. Musk, you right now are in a very difficult position of being more in the headlines than President Trump. And having sat through in Washington, D.C., the last Trump administration, guys who do that are not around too long. Tread very lightly, Mr. Musk. And watch our economy. The Fed's doing a good job. Leave them alone, please.
And the one thing I find quite ironic is talking about raising the debt ceiling by $1.5 to $2 trillion, but cutting spending by $2 to $2.5 trillion. That somehow
you sound like Chip Roy. He was not pleased about that.
And we don't usually line up on some things, but it is cognitive dissonance at best, I would say.
All right,
but
Michael
you can't
Farr.
do it. There's not $2 trillion in there to cut. There's just not $2 trillion there to cut. Right.
Yeah. Far and farther.
Yes.
Ron Insana, thank you. Michael Farr, thank you. Appreciate it, guys.
Thank you.